Welcome to the ATX DAO Podcast, the hub for exploring the forefront of blockchain technology in Austin's Web3 community. We connect you with innovators within ATX DAO and beyond as we venture into the world of decentralized technology. So crack open a beer and join us for a front row seat to learn about the innovations and trends shaping our digital future. This is the ATX DAO Podcast.
And you're just like, this is my tribe. And it seems like crypto has that vibe itself. Especially in DeFi, right? And like, I would love to hear like your story of like, firstly, how the fuck did you find yourself into crypto? And then like to Gauntlet, tell me about you, bro.
First heard about crypto fall of 2019. I'm not sure if you guys, people, remember Pool Together. Pool Together is one of the first like DeFi protocols that leverage lending protocols under the hood, a synthetic compound and Aave to make a no loss, what they called it back then, a no loss lottery. Whereas an idea, you can deposit capital, anyone deposits capital earns yield, right? And every week, one of the people that deposited capital receives all the yield earned from everybody in that pool for rewards. And it was like a very cool experience where your principal wasn't exposed, and yet you could always get you always had like an interesting upside potential. I think like that was kind of my first iteration of DeFi, was having Leighton be our professor. It was really funny one time having in a class where had everyone signed up for Pool Together, gave everyone DAI, and he's like, and obviously it was a joke, but he was just like, just so you know, I mean, let VCs know, we just onboarded 30 users in one day. But he was a very, very brilliant professor, very brilliant person. And, I wasn't sure what I thought about crypto back then. DeFi, I thought it was interesting, but I didn't think it made sense. But obviously I paid attention. COVID occurred and I was still in college. And I remember seeing people's, like, the big move in crypto back then was swapping interest rates between synthetics, compound, and Aave. And it was interesting, but I didn't understand why everyone was like paying obnoxious gas fees for 1% difference in yield. It actually, I think if you did the model out, generally most of these swaps, unless you had over $1 million, was quite unprofitable. And then the kind of the first time my DeFi only made sense was Year in Finance. It was kind of like, okay, depositing and swaps between these lending protocols and also is highly inefficient, gas fees, you're competing on basis points. The yield wasn't really that great. You're earning between 3 and 8%, on any given day on a variable 24-hour rate. And so like what Yearn kind of like showcased was this idea that everyone deposits into one vault. It does this cross allocation strategy, and everyone shares the gas fees, so the cost is minimized. And the yield is generally higher because of the efficient allocation strategy for all people. So the yield went from an average return of like 4% to like 8% for a retail user of $1,000 or less, like overnight. And I was just like, wow, okay. Imagine this world where like you had 6 retail banks offering these different saving rates, and you deposited capital in one savings rate, and say these guys were all beholden to some kind of like strategy where if they're not offering, the best savings rates, you cross allocate to another bank over the overnight money rates based on kind of like a risk profile. And I realized, wow, imagine a world where rather than banks taking massive margins on us, they're trying to compete and offering the best savings rate, the best, or potentially lowest borrow rates, whoever on interest rate loans, reducing potentially the margin at cost or the margin return compared to overhead, and maybe smart contracts somehow like reduce diminished costs on overhead as well on administrative costs. And I'm like, wow, okay, this is actually cool. And as a finance nerd in college, financial economics, math minor, all that stuff, I'd be like, wow, okay, DeFi actually does make sense. It's just not arbing basis rates, base rates across lending protocols. And I'm like, okay. And so I got really active. I learned Solidity back. I actually learned Solidity the spring before, spring of COVID. And I actually started applying it to build Urine Vaults and got really active, on Harvest Finance, APY, and, that kind of ADA and PH community, and sushi. On Urine, I was actually one of the first buyers of DeFi back when it was like $300 a share. So I was very happy as a college student dropping 1K in that and riding that to Valhalla.
Yeah.
Lost a lot of it along the way in the DeFi summer, but it was a really good experience. But that was kind of my draw into DeFi was, seeing the actual use case, seeing the insanity, which was like the food coin meta. Love it when Yam still pumps 100% randomly with $300 liquidity. Makes me laugh still to this day. But that kind of brought me to DeFi. It's like, okay, there's this meta here where, if you can find a use case, you could actually create a world where this could benefit the average retailer, the average person. And my kind of thesis back in the day was the first use case for DeFi was to finding some way to convert these food coins into high yield junk bonds and pitching them to somebody. That was my pitch because it was actually virtually useless, most of the stuff we were doing. And everything was kind of a fork of everything else. As long as the code didn't differentiate, the exploit risk was low. And depending on the underlying allocation strategy, if you had a vault. And so like that was kind of my thesis was like, hey, how do we frame this? And that kind of brought me into, working portfolio management while I was in college for a pretty large institution. Eventually trying to build my own startup. It didn't work out. And then, working on working on a lot of different protocols, Alchemex, Reserve, Spool, and a lot of other different projects across DeFi to help, in various roles such as data analytics, engineering to smart contracts. It's not smart contracts, product management on and helping guide the smart contract design for users to just general growth. Eventually, somehow, it led me to applying a role at BD at Gauntlet, and somehow I got an interview because I know when I think about Gauntlet, I think about all these gigabrains, quants, and PhDs. Like, there's no way. I kind of applied for fun. Suddenly, I had an interview, and I started going farther in the interview process, and I got an offer. I ended up here. Currently at Gauntlet, what I do is I lead the growth on our Morpho vaults and our Morpho deployment. When I took over, we were about like 116 million TVL. Now we're about 500,000, and we peaked at 800 million in January, and focus on getting us to $1 billion and higher in lending, and trying to make Morpho and ideally Gauntlet, Morpho the largest TVL lending protocol in crypto, and ideally make Gauntlet, one of the keystones in that.
Wow. Okay, there's a lot to unpack here, but no, this is awesome. It's like it's really interesting because we came from this point where you were like you espoused like all the virtues of living in a city, a tier two city like Portland or Austin, finding a tribe. And then it seems like your tribe was like, yo, I'm gonna be a finance nerd. And because of that, like, it originally like disillusioned by just doing RBOPs on like fucking interest rates. And then being like, dude, we need to come up with a better way to actually like, stack these gates. And it's the food coin craze was exactly that. And it's funny because in like circa 2018, 2019, I thought of the exact same thing. I'm like, bro, we should be tranching this fucking risk to like create a new instrument, which would be way more sensible. You could get a bunch of triple Bs and triple Cs and triple Ds together, and eventually you have a financial instrument that's like, you know what, I might park some money in this asset, right? If not, it's just like you said, ride to Valhalla on straight up like Yam and Bow, and you're like, fuck it, I have 100x log basically on this thing now, you know,
Yeah.
which is hilarious to think about. But I love that, like, also, you mentioned that you were a founder. And one of the things that I think that is a lot of value for us in the DAO, right? And I want to touch about like how you got in the DAO as well, and obviously dig more into Gauntlet. But I just love for you to just tell me about your founder experience because it's like that's a part of many people's stories that they don't hear about. And we have other founders that listen to this. I would love to hear about like what was a big takeaway during your thing. You don't have to share about what you necessarily built if you didn't want to, but like what was the big experience on that? And if you had to give advice to anybody.
Yeah. My kind of founder story ended up for me doing like helping with portfolio management for a CFI about, I found out later after if I had 50 million AUM, they were using all my strategies via Telegram DMs, the CIO was. This was back in like fall of 2020. And I ended up like, I was in college. I'm going to go to Ernst Young and Morgan Stanley, the two offers I got to either do strategy consulting to work in the blockchain consulting or go work in structured products at Morgan Stanley. Two interesting things of mine, finance and blockchain. And so I was like in the forums on Telegram helping, apparently I found out later, this fund, CFI fund, earn yield on their products. And I kind of found that out 2021, my senior year, where they tried one of the strategies I don't think I recommended, and apparently lost money on it. And I ended up on a call with a bunch of people saying, it's not my fault. It's not my fault. It's this kid's fault. And I'm like confused, like what's going on? Because I don't know who any of these people are. And it ended up meeting this company that, basically I helped with the portfolio strategy and doing some consulting with them as well. I was in college and kind of came to the vision where it's like, hey, we found out there is in fact risk in DeFi. We need to figure out how to build an insurance fund. And my thesis was like, the insurance risk in crypto is not insurable in its current state. And the kind of idea is how do you make an attractive product that is insurable? And my idea was like the current models of insurance back in early 2021, there were products that came alive while I was designing it, but focusing on the vision was insurable risk was kind of fully focused on the retail, getting coverage or exposure to their losses. And I do feel like there is some kind of associated risk to the protocol. And if there is a way to design like protocol level insurance, that might be a really attractive model to help DAO scale and protect their users in retail. And the problem with insuring a protocol is how much risk can you need to insure? How much risk is actually viable to protect them? And who the heck are you going to get to buy that stuff? And so my vision was this idea of like creating a bunch of insurance pools and creating one pool on top that people deposit into. And basically it structures the loss across every single pool. So if you had a pool, say you're exposed to 100 policies, was kind of my largest vision, earning like say 6% in premium. And we would charge different premiums on like tokens that rebalance to USD versus like USD paid in different assets. And like the idea was like if you had a structured product with like 1% to 5% say exposure per loss event, then you know your loss on a per loss event is this rate and you're earning this rate. And so if you had it diversified enough at scale, then you could price out losses while earning a yield bearing product. And if you could integrate DeFi for lending for liquidity pools, you can earn yield and actually outperform the loss rate quite easily on top of the structure of product. And that was my kind of vision, was how the heck do you build this? And that was kind of like, and I kind of presented the idea and they wanted to support it. And so we kind of like pursued that journey. Found out there's a lot of problems, especially on Ethereum mainnet. As many founders know when they're trying to build DeFi products, the gas fees, I think when it was finally built, came down to like 2-3 ETH. And it was just like, oh my God, this is totally gas efficient. Trying to build a team and a proper team that can execute and focus is also very difficult. And trying to create your vision and adjust to the market conditions I understand is also very difficult. And so, when you in general, like situations, like I had a CTO that was Russian. The Russian war broke out. I lost 4 months of runway because he had to leave the country, like there was a lot of things that happened, but it was like this kind of idea that like being a founder is incredibly difficult. You have this ideation, getting it to market, and then trying to get it validated in product and get to that larger term vision is incredibly difficult. And it's hard to see how it adjusts over time as you're trying to build it. Obviously, we weren't even going to get our product to market, and that was kind of the frustration. Got the testnet build and it wasn't viable, and it was just like very difficult. Made some calls and had to shut it down. Which was terrible. It's terrible and it's like as a founder, you think about like your founding team, you think about everyone around it, and it's like it's a terrible experience for everybody. My advice to founders, I don't know if I have one. Learned my mistakes. Like really focus on trying to lead by example. Focus on always you're obviously going to put a lot of hours in. Make sure you take a day off to yourself because make sure that like you have like a really strong technical co-founder, ideally, if you're not that. And if you're not your technical founder, make sure you have a really strong growth-oriented founder that understands an ecosystem very well to help work along that and guide it. You have to be someone you really, really trust. And like that, those are really essential because there's the go-to-market, and then there's like where you want the product to be, and it's where the product is at. And if you have two brilliant brains working together to really like understand that dynamic, I think that's when something really beautiful can flesh out. As long as you have two brilliant people that are willing to execute aggressively, willing to make that happen. And I think that's like, that's one of my founders is like, make sure you understand what you are and what you aren't, to make sure that like you can build around that, and make sure you like when you build a team, like you have someone that can like someone really close that can like build upon your weaknesses, and ideally their weaknesses are your strengths. So it's like a very synergistic relationship, and it always builds in trust. I don't think I'm saying anything like crazy, not like no new paradigm and advice. This is very obvious, but it's like always reiterate that because I think a lot of founding teams go through a lot of trouble, a lot of like struggle, and having that guidance and like having that second arm, I think is like really valuable. And ideally maybe eventually find an operations brain, whether a co-founder or someone else, to help with all that nuances. Ash, you're a founder. A lot of founders here, when you hear taxes, you're like, oh my God, you're here, 1099s versus W2s. You're like, what do I do? And having someone design that and structure that really well is also incredibly helpful. But ideally, you want those that don't have to be experts in a specific field, but are passionate product, willing to execute, and willing to own one specific business line, and their like brains are synergistic with yours. I think it's a really, really like really successful growth. There are a lot of highly successful, like theoretically on growth, like hitting out there. There's a lot of highly successful crypto companies, and when you meet the manager and you have to be honest, they're like, yeah, dude, like the people I hired are way, way better than me at selling, but they were able to get the product from that 0 to 1, maybe 1 to 100, and get those teams around it to build them, and now their job is to keep it running to that next like level you're trying to get. and I think that's like the biggest advice you can ever give to a founder or a founding team is it's like you don't have to be the best at any everything or even anything. You have to be willing to own it, execute, and find synergistic brains to like work alongside. And if you build something compelling, if you actually be honest about how compelling it is, if you really do build something compelling, that's very difficult. I think for me, when I was building it for other founders to build something compelling, that you will get people that are so compelled by the vision and the PMF that you'll get executors on board who can really own a certain area and let the founders focus on growing what's next. Because again, I don't think a founding team has to be experts in much. They have to be willing to execute on a lot and build something compelling, that PMF, where they can find those people willing to own that spot. And I was looking at that BD manager example because it's like, it probably is right. I mean, a lot of teams, I'm like, wow, yeah, I found a way better engineer down the road. I found a way better this down the road. But you put the hours in to get it there where it was compelling enough.
I agree 100%. I honestly think that this 0 to 1 magic that we're talking about requires like kind of like, we were talking about this earlier before we started recording, right? Like even at a team at Gauntlet, which is like much bigger than like an organization like ours, you have a bunch of people that are still founder mode where you're like, dude, I wear
100%.
and it's like you got to own your shit, and it's like that's the real magic to being successful, right? And I think that that culture fit is why I think that people thrive in crypto, and it seems like why you're thriving in Gauntlet. Like your mission to grow Morpho into $1 billion product is, it takes big balls, and like it takes a lot of heart, and it is like a Sisyphusian effort in a way, right? It's like full on founder mode. It's like this is your founder mode for pushing that boulder up the fucking hill every single day, and that's impressive. And it seems like it makes a lot of sense when I hear about your founder part of your journey, why you're so good at this part of your development in your journey, right? It makes it like, because founders take ownership over shit, and you have an organization that just seems like a Gauntlet with the team. And I had you introduced me to the COO there. That guy, from even our brief conversation, you can tell like he's like, dude, he's not only a cool person to hang out with, but he like empowers people that's around him to be like, go do your crazy. You kind of know what the mission. I'm not going to tell you how to skin the cat, but just go fucking kill it and skin that cat, which is pretty fucking awesome, right? I gotta say, it's like it's a pretty cool place culture wise for you to be thriving and empowered.
Working at Gauntlet is really cool. Yeah, it's a large company, 7, 8 business arms that we're running between consulting and now we call curation. We do a lot of different things, and this is good context for how people I think should think about Gauntlet and why I'm incredibly bullish on Gauntlet's future. Is like when you see a 75-person company, I think that's currently the size. I'm not fully sure. It's what you kind of see is like how does a company like that stay in a founder-led vision? And the reality is like what we met because of all these business arms we manage, ignoring finance, which they're great, ignoring recruitment with the great operations. It's a lot of teams of like 4 or 5 people owning a business arm, owning the TVO, owning the revenue, and really growing it aggressively. And when you have a vision towards another product or another future, you also own that aggressively. And so how you I think like as you scale a company, like how you keep like that strong founder vision is like, you keep rebuilding these teams, 4 or 5 people that understand that 0 to 1 journey, that understand that 1 to 10 and understand like that 10 to 100. Because every journey is very different. A lot of the journey in DeFi, in my opinion, is TVL focused. That first 0 to 20 million TVL is a grind, is what I think about it. And that 20 to 100 is actually a much bigger grind. And I think after you hit 100 plus, like you now have like generally some kind of notoriety in the space. And you have to almost think now, like, if you have notoriety, if you have a natural flywheel, how do I really lean that flywheel? And it's at 0 to like that 100 to 500 to a billion requires very different flywheels to grow and scale. And you have to think about like the kind of capital you're trying to distract, the kind of teams you're trying to work with from that, and how you're trying to scale aggressively with them. All of Gauntlet's business arms are like giga brains, giga smart, very real at this company, and they own that. What makes Gauntlet I think really unique is like from a lot of companies is a lot of companies always focus on 1 or 2 products. We keep that founder-led vision, that founder mode, but small teams trying to build and own their own product. And it allows like Gauntlet to become like a Leviathan, its own mafia internally and externally. As we're seeing with new products, new visions and protocols and teams collaborating, building out from the Gauntlet business arms into separate companies, it's like a Leviathan of owners and founders who learn each process and how it takes to get there in their own various like expertise. And every time you replicate it and like on another product, another process, you have to reinvent the you don't have to reinvent the whole wheel. The wheel's already structured. You just have to figure out how does it work on this new product design. And that's like the vision and future of Gauntlet is like we're going to keep scaling and building each business so we have a clear vision to $1 billion for. And very soon, I could see a world where Gauntlet owns 15-20% of DeFi.
So okay, so you mentioned that, like, for example, like you're creating. So let's rewind it a little bit. At Gauntlet, if I remember correctly, you guys started off with agent-based sims and Monte Carlo sims to define like what's the best kind of risk parameterization for protocols. That's just like a bunch of fancy words to be like, bro, let me run some crazy fucking math to just like tell you all these crazy scenarios where you could fucking die and like don't die, and basically we can help you stay alive, right? That's the inception point. At least that was started in the beginning. Now you've branched out. Am I right in that
Yeah,
characterization?
100%. Yeah, where we started as risk managers first and quants and PhDs. Gauntlet is a consulting business first, and it's like in its early vision. And the whole idea on this vision, like I think the best vision you can like think about it is like how we were kind of talking about DeFi, like what the heck is this? Again, our fearless leader Tarun Chitra also was thinking that as well. And his kind of like his kind of idea was, and Tarun's awesome to work with. If any company can work with him, like he's awesome. And but like with Tarun, like I think his kind of belief is you can best like nail it down to is like this idea that like we have all these interesting things in blockchain technology, but if you don't quantify it and then like convert it into digestible information into a way institution will understand it, it'll never achieve the product market fit it needed to. It needs to get to like really be what its vision can be. And so like kind of what his like perspective was on trying to do was like I think like his perspective was like making all these research papers and all these designs to to ideally have institutions pick up, read, and understand what are we trying to do here. And this knowledge grew him, the founding team, a lot of expertise in crypto and DeFi because they've been doing it since 2018. When 2020 and DeFi summer took off, this was a very clear product market fit, just not just for institutions, but for actual DeFi and crypto, where we can now take our expertise and what we've learned over the years and apply it to do risk management for DAOs, specifically in lending. So we work for all the largest lending protocols in crypto and did a lot of the risk management and expanded from that kind of vision there. Yeah, a little context. We'll let you continue. But that's kind of that's the high level view and a little more depth than, but going further in the larger vision.
Yeah, that's it's always good to. This is one of the reasons why I asked about like we have cold opens, right? Like in the pod, I want not only for the vibes, but also like it's good to hear about where people come from, right? Because it's like an obvious indicator of like their like where they're gonna go, and the journeys and experiences they have. It informs their decisions tomorrow. Like today's decisions basically make your day tomorrow. And kind of like knowing your personal experience as a founder and what you do at Gauntlet, and then understanding where Gauntlet came from originally. And Tarun, he's like an ex-DE Shaw guy, and coming in from research and stuff like that, going into this is super interesting. Now, obviously, like it's a little bit beyond the food coin craze. It's a little bit beyond DeFi summer. You've mentioned that like going to your Morpho vault strategies. Now you're taking research from risk management to basically being like, hey, we can deploy a lot of strategies like yield bearing strategies, create new kind of opportunities and ways for users and protocols to like really expand their offerings. I would love to hear more about that. Dumb it down for me as if I'm a golden retriever, like because I very much am. Yeah.
Yeah, I think the kind of vision is consulting is still a great business model. We still run it. We do a lot for a lot of companies, but the idea of the world is like we have all these experts. We're advising on the business models. We're advising on the products. Might not become the product. And I think that's kind of interesting talks about how we're growing at Gauntlet. Is you kind of see what we're kind of doing is we're building we're building Delta Central products on Drift on Solana. We're building lending on Morpho using our expertise and doing consulting lending on all these protocols. We're doing restaking now in Symbiotic. We're kind of like managing various curated Symbiotics by Gauntlet, and we have Era now, which is basically a DAO treasury management tool as well. We look focus on helping DAOs support them. And the idea and the clear vision for us is like, listen, we've been advising. We started as the experts because we had the knowledge, We took that knowledge and then we applied it to become the experts in advising growth and specific designs for protocols on how their product should be. And now the kind of other vision now we're kind of taking is another step layer further with smaller parts of the team is own and become the product. And I think that's kind of the vision of Gauntlet is like we're trying to now build the products that like really will become, I think, we think pillars in DeFi and keep scaling those products to be pillars in DeFi. We do believe we kind of hold the same vision where we believe institutions are coming, we believe retail are coming, and we believe like why would you not want to integrate with the best risk manager in crypto? And that's kind of like our view. And as long as we're building the products and owning them, you don't just got to take our advice. You can be enabled by the products we build. And I think that's like really what like the kind of the TLDR, like the high level view a little further down of like how we're doing it. Where it's theorizing to advising to product implementation. And we do all of these things already. We still theorize. We're always pushing the needle. Tarun and our research team is always pushing the needle of like how to think about problems and how to solve them. Our advising team is still advising some of the largest institutions in crypto. And our product team is now building products that help enable growth. And I think that's just generally how we're trying to take it is like, we got experts. Let's use their knowledge to keep growing this company and push the needle further to, being the best risk managed option for anyone and everyone in crypto. Whether you're a liquid fund, whether you're a whale, whether you're a retail, whether you're an institution, we're trying to build products for all of you.
So you guys it seems like you guys are just one big applied research madhouse, right?
100%.
You're like, bro, I got all this fucking expertise and like gigawatts of brain power over here. I got GPUs churning away over here. We need to put these goblin processing units to work, basically. And by GPUs, I mean like your devs, like that you're talking about, your research people, your mathematicians, including the present company over here with you, right? But like, I mean, it's a requirement of like an application of this stuff to do other stuff, right? Like,
Yeah.
and I really appreciate that. So like, I would love to hear. Okay, let's say you're a DeFi protocol, like, and you have 46 billion in customer TVL managed, right? If I have that accurate, I'm like I'm trying to see what this amount is. I think that number is always 35 billion is in your models, which is like insane to think about.
It's a bit higher than that nowadays, but yeah.
Well, okay.
Yeah.
So like, what are some key strategies that like Gauntlet would like employ for economic safety for like let's say a protocol? Like just once again, just you don't have we can drill down, but I'm just also curious, like what off the top of your head?
Say if you're an institution looking to borrow USD against your GBTC to say act as a basis trade. One of the most important things you got to think about is what is say like what are my loan to values, what's my liquidation pathway, what is the oracles, and how do I make sure that like I'm managing my positions. And one of the worst things that could ever happen, say, is like things that happen that aren't in your control. For example, say you have a position, 50% loan to value and 80% liquidation rate, which means just quite healthy. You're arbing, say you're taking a USDC and you're depositing into like the Athena and earning yield on that strategies. And the rate on the yield of Athena is higher than the bar rate, therefore it's a profitable strategy. And then what happens if say like the Oracle design ticks like a zero and you're randomly liquidated and it's not your fault and it's like the Oracle breaking and you're just like, what the heck? Who's going to compensate me? What is this going on here? What we kind of do is like what we kind of come in is like on Morpho theoretically is like we make sure the oracles built are the ones that are going to be best for borrowers and lenders. And it's not always a market rate oracle. Say if you're an asset with 7 million liquidity, 9 million liquidity, and people want to get $6 million in loans, first of all, we wouldn't do that. But secondly, probably best not to have a market rate oracle. To have something that tracks the underlying value of your asset that like can always like track the proof of reserves or the NAV, the net asset value, fundamental rate, whatever you call it. And then if it doesn't produce a certain value within a specific deviation, then reverse to a market rate oracle to get to verify. And like what we kind of do with our knowledge is we kind of build and design like parameters where you have ideally full control over your borrowing experience, your strategy, and things that the lending protocol should own as curators like we own and use our expertise for, and like make sure that you're not exposed as a liquid fund, as a whale, to stuff that necessarily isn't in your control. And that's kind of like what we do. And so like applying this expertise and knowledge, if I understand correctly, the highest economic value is like things we do on Morpho. What assets do we list? Why are we listing them? What's the risk profile? we kind of do all the diligence on that and, allocate accordingly. And we kind of build vaults by risk profile on Morpho. We have a prime, a core, and a frontier. Prime, incredibly low risk. Currently exposed to 3 assets: Rapidest ETH, CBDC, and Wrap ETC. High liquid. It's relatively very safe, I would say, and you're always safe. Core, high, a little bit more of a risk managed strategy where you can see what it's allocating to, what the allocation limits are per asset by type. And then Frontier, where it's just a yield maxi. Vault is kind of what we do with still the Gauntlet risk management, but we say to Doc, there's a shot you lose, you take losses. And what you can see when the assets get listed and where it gets listed, if it's on Core and Frontier, generally pretty safe. If it's only in Frontier, listen, I got to be careful on the underlying asset. And then we make sure the Oracle design is really strong. The Oracle provider is good. We make sure supply caps are stringent on total borrows to make sure that we can always access very clear liquidation pathways on the assets, and to make sure you're protected, both suppliers and borrowers, from things that are not necessary or could potentially be out of your control due to a failure of the protocol. And we kind of use our expertise to make sure those things don't break. It's on you. And you, if you're a large borrower, here's my Telegram. You can always contact me with questions.
Yeah, no, I like it. It seems like your whole thing is dude, the way we look at assessment is that we look at it from the ground up, right? You're looking at from infra to chain mechanics to Oracle feed price mechanics to validator mechanics to protocol mechanics and then the asset mechanics, right? And then you mentioned this interesting thing, which actually was my next question because you kind of touched upon it. It's your Symbiotic vaults product, which is kind of funny. You're going full circle to your insurance vision, right? In the beginning, right?
Somewhat, yeah.
I mean, you are in a way basically creating tranched risk across various faults, right? And that creates isolated strategies in a way, right?
Yeah.
Which is kind of an interesting product. I would love to hear about that. I'd love to hear about this new thing because I read about that in January of this year, and it was oh, this is pretty fucking cool. The restaking that you mentioned, right, with CBE and W-stake ETH, that's all pretty interesting to see how this flows into it. I'd love to hear a little bit about that.
I want to premise this in saying I am not the expert in restaking. If restaking was brought in my interview process, I would have been in so much in trouble. I'm not an expert, so I'll do my best.
Neither am I.
These are one of the products. These are one of the few products because I don't have to own them. I avoid them like the plague. So I want to comment on that first, but. Basically, the kind of idea on Symbiotic was trying to create similar vaults to restaking, like curation, where you can deposit assets, and these assets are then, I think I get this correct, is given to validators, and they can hold and they pay in either right now points in exchange for having these assets basically given to them, and they use it as to slash if an event happens on validation, to slash the risk, and the vault holders take the loss. People deposit in the vault, and the exchange rate for holding that risk is the points. Why the curated model is interesting is for a kind of design like this. For Eigenlayer, they have very few validators selected, very few allocations kind of put together into and what they allow to deposit to on validators is the curators can use their expertise to maybe select validators that diversify further, select validators that can hold more, so diversify to do a larger asset allocation across the space, a lot more assets to be deposited, and choose validators that meet the risk profile where they think the slashing won't necessarily happen, and allow them to earn higher yield in exchange for onboarding potentially more risk. And then the curator of these vaults are behold the risk managing it. Eigenlayer, and if I understand it correctly, again, I'm probably going to get a tweet thread about how I'm very dumb about auto restaking. I apologize now. Eigenlayer selects very few validators, takes very different deposit assets in demand from the validators, and they allow that to produce, restaking points on their assets. With Symbiotic, any asset in demand by a validator can be used to create a vault, people deposit to, and they can earn excess yield on that. And when the deposit allocation goes to these validators, the curator is basically responsible for how they allocate, and ideally using their expertise to allocate to validators who will not slash, which is basically a loss to the depositors. And ideally, if there's no slashing, you get more points than more yield. Ideally, that will reflect in yield eventually. Then would have just holding the asset simply. So I hope that it was a high level view good. And we have a very expert restaking team, including Tarun, who are very active in restaking since its inception. Not me, thank God, and who can explain it much more eloquently than I can, and probably much more accurate. But That's generally the kind of idea that, a one-on-one level for the average person, what's restaking and what's the difference is the idea of taking assets and deposited into a vault or tokens and deploying them to validators to use that for, a various like strategy, staking strategy, and they offset and pay a bunch certain amount of the yield in return for receiving those tokens. And so the idea is just like extra yield, and the risk is if the validator has a slash event occurs with the validators, the vault holders potentially take a loss. And so you're really relying on the curators to selectively choose validators, and ideally as the skills and size, making sure they can diversify and allocate. So if you're, across 10, 20, 30 allocators, which kind of guess makes sense to what we're talking for the insurance product, then, if a loss event does occur, it's marginal compared to one or two allocators only. Again, I don't think, and maybe you can correct me, I don't think they have enabled slashing yet, but they will be very soon, which means there will be much more payment for those allocations.
Yeah, I mean, like whenever I read that, it really did resemble, and you mentioned the insurance product thing, right? Like it's really about like creating risk mitigation itself with these products. And like the cool, interesting thing with these isolated strategies is like, oh, you could have like a single collateral type vault, and then basically you could have that strategy run with that single vault, which is really interesting. You do tailored allocation. You could have various kinds of configs on this, and ultimately it's just like loss containment, right? It's just like it would work as a network that faces security issues. It's delegated to this thing. And I was like, basically, this kind of like resembles like an insurance product, which is kind of like a funny way to think about this thing. So in a way, you kind of bastardize this thing into inception, like in Gauntlet. You should tell Tara and I'd be like, bro, it was all my idea. I'd be like, it was that fucking.
Yeah, no, it had nothing to do with it. I like, yeah, when I hear restaking, I'm just like, oh, like, I don't know. I like simple DeFi. My limit is like Ohm.
Yeah.
This is too far for me, man. It's into the meta. I don't know.
Yeah, it really feels like we're going into this phase where like now it seems like there's increased financial instrumentation that occurs, right? And like this increased financial instrumentation era can be like these synth instruments that are created as a result of these various kind of functionalities and more interoperability and changes
Yes.
there, which is super exciting, right? Like, I feel like this era is going to be owned, this next wave is going to be owned by real people who like say, yo, I'm going to replicate these new financial instrumentation, or be like, I'm going to build the craziest fucking thing of like ridiculous products and then make it highly left curve. And like, I think this is going to be super exciting for this next wave. I also read that Hedge Jupiter liquidity provider paper that you guys did last year. That was super interesting.
Yes.
I would love to hear your thoughts on that. And it's like, really, it says Gauntlet, but like, I'm just wondering if it's like disclaimer. It was like Jono proofread this
Yeah.
thing. I'm giving
Yeah.
you as many fucking flowers over here because you're one of us, bro. You're one of the ATX DAO bros. So I'm like, clearly you're the genius behind this.
Again, I guess we'll call it Jibby coded, or is what we call it internally. It's Jibby interpretation. So I what I think about like with HLP is an idea of like we have some really interesting products. There's kind of like perps has always been a key stake, I think, in DeFi. We have great products that fully rely like just generally centralized exchanges, Binance, Coinbase, KuCoin, all these different things that have like a lot of perps and leverage logging on various order books on their model. And then we kind of like the kind of push is how do we design a fully on-chain version? The first iteration, I feel like that was highly successful is DYDX, which built like kind of an AMM pool, if I remember correctly, at least this is the V3, I think, that basically allocated to you deposit USDC and it allocates into a bunch of different assets. And I think the further iteration was like USDC allocated to provide order book liquidity across all assets. See on intent-based models. I think in 10x, it's probably the biggest one I can think of, where the idea is to access order book liquidity from market makers to fulfill orders using like Binance, while also being a mostly on-chain product. And kind of like the third, which kind of is a touch on DYDX, and I don't want to like I want to make sure I give them the flowers, is a fully on-chain AMM model that you deposit this asset and you provide liquidity to very distinct assets, and it allows people to long or short those assets, and that like token representing that share of those assets accrues to yield. And the two largest is Jupiter and Hyperliquid, where you deposit say USDC into Jupiter. Let's use this as an example. You deposit USDC into this product called JLP. JLP basically is a mixture of tokens in a basket of USDT, USDC, BTC, ETH, and SOL. And basically, that asset is holds and is long those assets, and generally is provide liquidity for people long or short on those assets as well. And so it's kind of like it's very directional to like the movement of those assets where you're in the price action, but it's diversified into an ETF. Hedge GLP was an iteration on the product that we built by Gauntlet using Drift as a curator. Gauntlet's curated on Drift, where basically you deposit our first iteration of Vault, which you're talking about, was you deposit USDC. We take that USDC, we buy HGLP, and then we also open equal amount of shorts on the Jupiter Purchase Exchange in those same denominated assets. So BTC, ETH, and SOL in equal amounts, rebalance it every hour to every 24 hours, and you collect the fund. You basically, rather than being directional along these assets like you were on JLP, you were short. Like the assets open an equal amount of shorts on the Jupiter Exchange, and now you just simply collect the funding rates. So in a very hot market, you can earn probably between 25 and 45%. But if no one's shorting, then the yield could be very low to negative. And the idea of kind of you're talking about people building iterations is like we're like people kind of in crypto now where they see Athena, you see Resolve, you see HLP. We're kind of building this product design where we're building actual like instruments used in normal finance, and we're converting them into a tokenized form that accesses the on-chain blockchain model. Hyperliquid and Jupiter are very ideal, like these kind of just design models, because it's fully on chain. You can do everything fully on chain, and it's fully transparent. And that's kind of the cool part about these designs is like you can build a fully transparent product on chain that will that doesn't rely on like any off chain market makers such as an intent based model or maybe a full on order book via like a centralized exchange. And so like it's a fully on chain product that builds like a delta neutral strategy. And by holding this, you're exposed to a very specific directional trade, which the directional trade is obviously a delta neutral, and it collects on the yield. And I think what you're going to see on the iteration of like crypto and DeFi products is moving from food coins, and we're building like really actual products in normal finance, and we're converting them in what is called an RWA, where it's these like hedged products into like products that have a directional source of yield that earn on those yields and from a very specific activity that happens, and the yield is real. Or you're right, we go fully down the left curve and we build something crazy that is generally probably the same concept of this, but meant to attract a very specific audience. We see a lot of stablecoins evolving. We see really cool RWAs basis trades, USDC carry trade by Superstate, HGLP from Gauntlet, Resolve, taking another iteration on the Delta Athena Delta neutral product. There's a lot of really interesting things happening. And like you're right, it's these RWAs that are either like more intuitive design on top of each other, but like focused on like a very clear strategy that's used normal finance, or it's like fully left curve. And we're kind of like it's like a spectrum. And we're kind of seeing like those two pathways, and we'll see like new things evolve from that. My ideal world is like we start calling everything a stable coin and we start calling them dry powder, even though it's not fully accurately dry powder, it's more synthetic dollars. So like we start valuing the dollar by their backing, stable coins by their backing. We start valuing the basis trade, not the current value, but the expected future value over a 3-month duration. We still keep looking at the left curve stuff, like what the heck is going on over there, and then we start seeing a normal finance being built on chain, just much more efficient.
Yeah, I mean, firstly, just want to get this out there. It feels like you missed the obvious thing in HLJP to name it as the Jupiter trade, kind of like the Magnetar trade, right? Basically, it's a delta neutral thing. I mean, come on, bro. Like,
Yeah.
that was just a layup right there. But other than that, like, I'd also say that I agree with you 100%. I feel like this trend is that it's going to be really interesting to build these products and then see how they're applied across these existing instruments. And now with seeing you and Das, like it was really interesting to see the wave of institutional that's always been there. I
Yeah.
mean, you guys have seen it, but like being a dumb DeFi guy like that's building like crazy shit myself, it's kind of hilarious to be like, what the fuck am I doing in these rooms with like these big banks that are here and like talking to me about these instrumentation products, and they get it, which is hilarious, right? They're just as much degens as us. The only difference is that they're just required to look at it from like a very like kind of instrumentation portfolio of like I get these concepts, which makes 100% sense why the applied research model at Gauntlet is kind of like this overall trend why I think the industry is following it, where it seems to be you got to be doing the embracing the crazy, but also if you're building interesting products that like are minimizing risk or going X long in a synth product, like in a synthetic manner, it's kind of you're catching the right vibes.
Yeah. Our co-founders were visionaries. It really is true. Like
Yeah.
they saw the trend years ago and they knew what they had to do. But rather than seeing a trend, right, as you know, as a founder, they executed and they focused on like what can I do with my expertise and skills and to get there. And they focused on being available, being present, and doing research. And when there was a time to execute further on advisory, they did that, and like they keep executing, keep executing. Yeah, they set a very clear vision about what it takes to be great and be great as a founder. All of them did. Yeah, they were ahead of the curve, and obviously, hindsight 2020, they were ahead of the curve. But I think a lot of the skepticism was like for many people in crypto and DeFi is, yeah, but when are these solutions coming? When are these solutions coming? And 7 years to them starting to really look at these is not bad, in my opinion, from a counter time frame. Maybe we could argue too early, but I don't think so. I think it was like 2018 was the right time to get involved on doing this. 2017, post 2017 madness. And 2020 was a great way to execute and showcase the knowledge. And they're executing very, very, very well. Yeah, I don't know. If anything you learn from being founders, sometimes it feels like it's too early. You may be. Always think about it if you're trying to execute fast. But I think their timing was perfect. And it just shows their savviness and knowledge. Um,
I gotta ask also from the BE side of things, what are some of the biggest challenges you have towards forging partnerships with like a DeFi protocol or a DAO, for example? We're both members of ATX DAO, like or TDL allocators. How do you think about these problems?
When it comes to working with protocols, I'm always asking myself what's compelling. A lot of strategies I'm always doing that I think are really compelling. Some work, some don't. When I'm talking liquid funds, I'm more understanding what are your needs, how we start supporting those needs, or a whale. Say if you're a whale allocating X amount of capital, if I know what you're looking for, I know what we will and want to support, and I'll start building the business line to start building that relationship of trust where like we're doing things that you're already doing. And then like as we build that relationship and I know how much capital you're allocating to our products, I take your feedback very seriously about what to think about what to build next and do next. And then, working with founders, with protocols and founders, it's like, what's the strategy we can do right now? Is it compelling? And what's the strategy we can do later with our vision of what we're trying to build? And sometimes it's trying to make sure it's like saying not yet, but maybe soon. I can't give you a timeline. It's and that's kind of like what I'm thinking about the founders, the whales. Was there any other entity you mentioned?
Oh, well, no, just and just DAOs as well. Like, I'm
Yeah,
curious, like, how do you think about DAOs? Because like governance risk in DAOs is another very interesting thing. I'd love to hear about. Like, how do you guys weigh that? Like, how do you guys deal with them?
a lot of my DAO experience at Gauntlet is strictly with Morpho. It's understanding their needs. I think like I think a lot of governance members either are chaotic beings or two really care about the future of their protocol, and it's usually a mix of both. So when you think about like when you're trying to think about operation or something with the DAO, it's understanding where they're at. So something that happened in the forums recently is Olympus DAO is basically making a vault on Morpho, where they allocate SUSDS into the vault and like they earn yield on their treasury by allocating disparate to the markets. So it's like finding a product that can actually contribute to the long-term vision of the design of the protocol. I think is a great way to work with DAOs. And OWN basically is going to be a fully backed, basically I would call it liquid fund personally. They probably want to call that, where, OWN is backed and there's a true value to this asset. And you can like, if we can boost the yields up based on their holdings, it just returns better. It's a better return profile of the holders. And so it enables that vision further. And then when you're trying to sell to like a DAO, ideally you sell yourselves as like why we're the best, why you should do it with us, and why we're going to care about your future. And that's like the really important part. I think the last part is I think there's a lot of people always ask for money. People always talking about people rating the DAO treasury. When I work with stuff on Morpho directly that I'm involved with, I always think about like how do we make this compelling for OHM and how do we make this compelling potentially for the go to market on Morpho. And so like with Olympus DAO is a great example is like we like it's an idea for them to earn expert yield that can boost the return backing of the OHM backing like return which will increase the OHM backing at a faster time frame than previously. And to me that's like a clear go to market on the actual vision. I also think working with DAOs it's like you got to think like they want to make sure, some just care that their token is a higher price next year than it was last year. Some people care that the longer term vision is there, and the price is secure in a longer form, and it's trying to align those visions as well on that. Focusing on price action is always a bad game. It's really asking about why are we in a better fit if you're a long term holder next, like in 5 years this year than we were 5 years from now, a year before. And its idea is like when you're pitching to DAOs, if they can't see a larger vision, it's not worth working with them. If they can't see a larger vision and they do, and they very much think you're a part of it based on what your vision is, that's really great. And then the goal is execute, execute, execute. It takes a long time. Things don't change overnight. And it's the idea of like, how do we execute more aggressively to get that vision realized? And always putting things to a time frame. Those time frames are either too long or too short. Even a 5 year vision, I would argue is too long. 2-3 years is much more viable in my opinion. And you should be asking, are we going that direction you want to go? And what needs to change to get us that direction? That's really how you got to be thinking about it with DAOs, in my opinion. And if they're aligned on that vision, that long-term growth, then it's great. And if they're not aligned, you got to revisit if it's yourself, is the DAO's eyes, and which, I'm trying to say differently, it could be either, anyone can be wrong, or is it just not the right fit? And it's taking that and applying it and growing it. DAOs are very emotional by design because there's a lot of holders. Certain allocators' voices matter, less matter more than others. Smaller allocators can be very small voices. Large allocators can be large voices or very small voices. It's about building trust with the allocators and the voters and making sure that, you understand like their vision and where you're trying to get to and how you're helping to get there. And if you're not, you got to be honest with yourself if you're not. And that's like the really important stuff. That's, I think it's really important.
Yeah, I agree. I think that like that cultural fit needs to match, and that Riz needs to match that Riz, right? Like you're not going to be able to do it with some DAOs. You're going to be able to go the distance with some DAOs, and like the idea is like you're saying is like, dude, we think of it as like literally a 2 year time gap, and then after that, we able to evaluate with like more strategies to have that cooperative relationship.
Yeah.
You need going forward.
And what I'm saying is highly dependent on the size of the DAO, the size of the protocol. Your time frame should change the larger you are and the more standardized you are. If you're a new DAO, 50 million TVL, you got to be thinking about quick wins. If you're a much larger DAO with a larger vision, you got to think about, not quick wins, longer time frame success. Yeah, it totally changes too with the size,
Yeah, so much of crypto and like, everything in this game is dynamic and subjective as a result of it, right? So yes, there's no one magic strategy that works for everybody. It just doesn't exist. The only thing is just like put your money in like USDC and then just collect the interest, and like that's the safest thing, and just fucking look away. Like if you want to do that, and I guess that would work for a good basket of people, but that's just not the reality for many of the people, right?
Yeah, it's true.
I gotta ask. So we're coming up on time here, but like I want to ask you. So I don't want to monopolize your time because I know you need to bounce to other things. But I wanted to ask, like, what like where can people find you? Firstly, and then secondly, if you have a special shout out or request to our audience and beyond, you're putting it out in the universe. You're like, yo, it could be a hinge date for all I know, right? It could be like, bro, like it could be like, I want this to happen for us in terms of what we want to do. Like, I cede the floor to you, sir.
Yeah, if you want to contact me at Jonathan Libby, JONATHANLIBBY on Telegram, easiest way to contact me. Just give me some context. Don't just say, hey, bro, or hey, boss, whatever the scammers are saying nowadays. So I have some context. I'm down to always chat and try to help where I can, is pending I have enough time. And then, Twitter at OXJB is kind of what I go by. It's a fun one. I thought that was a good one as well. Yeah, anything to say is it's really cool to chat here. I just want to say thank you to all the leaders that have been involved with the DAO over the years. I think a lot of their voices are heard, and I don't know if they heard thank you enough. And over the years, there was Roberto, Malcolm, Clifton, Sam, Chase, Ryan, Mason, John. There's a lot of people very active in the early days, and thank you guys for keeping this going. I think it's really special. I'm really thankful, and I'm excited to see a DAO evolved with leadership like you, Ash, and Luke, and see where we keep taking it further. Always trying to help where I can and support you guys. And if I could be a voice that helps you guys grow and scale, and any of you individually or as a community, love to be where I can be a resource. But again, to all of you, I shouted out and plenty others. I'm really thankful for all your leadership and who you are as people. I know the DAO is in good hands because I know there's good people leading it.
It's fucking awesome. And thank you. And yeah, we're really uniquely blessed. We had like good vibes here and good people here. And dude, we're stoked that you're also part of the community. And we need to get you back into Texas. That's what it is. Hopefully, we can make some climate change work for our favor and actually get some like couple of mountains out here in the hill country and get some skiing in. That would be kind of nice. Till then, I guess we keep dreaming and we'll see you at the next go round.
Thanks for tuning in to this episode of the ATX DAO Podcast. If you like what you heard, please rate, subscribe, and share the podcast with your friends and colleagues. To learn more about ATX DAO, visit us at atxdao.com and follow us on X, Farcaster, and LinkedIn at ATX DAO. Thanks again for listening, and we'll catch you in the next episode.